Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 10th of February. Let's dive into the week's stock market news. European stocks defy trade and growth concerns. Central banks signal easing. European equity markets largely shrugged off concerns about US trade policy and slowing economic growth, with the pan-European stocks Europe 600 index closing up 0.60% in local currency terms, near a record high. Major national indexes also posted gains. Italy's FTSE MIB led the way with a 1.60% increase, while Germany's DAX and France's CAC 40 index rose by 0.25% and 0.29%, respectively. The FTSE 100 index climbed 0.31%. This positive market performance occurred despite central bank actions and economic data that painted a mixed picture. The Bank of England, BoE, reduced its benchmark interest rate by 25 basis points to 4.5%, marking the third rate cut since August. The BoE cited sufficient progress in controlling inflation and wage growth as justification for the move. However, the decision was not unanimous. Two members of the Monetary Policy Committee voted for a larger 50 basis point reduction, citing a sharper than anticipated economic slowdown. The BoE also significantly lowered its forecast for UK economic growth this year, having it to 0.75%. Furthermore, the central bank's latest projections indicate that inflation is expected to remain above its target until 2027, 6 months longer than previously anticipated. Governor Andrew Bailey indicated that further rate cuts are likely, stating that the BoE would assess the extent and pace of easing on a meeting-by-meeting basis. In the Eurozone, inflationary pressures remained a concern. Annual consumer price growth accelerated to 2.5% in January, up from 2.4% in December, marking the third consecutive month that inflation exceeded the European Central Bank's (ECB) target. Core inflation, which excludes volatile components like food, energy, alcohol, and tobacco, remained steady at 2.7%. Services price inflation, a key metric for policymakers, was recorded at 3.9%. ECB President Christine Lagarde attributed the increase in the overall inflation rate to expected base effects related to energy prices from the previous year. German economic data presented a mixed picture. While factory orders experienced a significant surge of 6.9% in December, rebounding strongly from a 5.4% decline in November and exceeding expectations, the broader industrial sector struggled. Industrial production contracted by 2.4% in December, reaching its lowest point since May 2020, during the initial wave of the coronavirus pandemic. This decline was driven by sharp drops in automotive output, 10%, and machine maintenance and assembly, 10.5%. Furthermore, despite the December surge, factory orders were still 3.0% lower compared to the same month in 2023. Now our insight into alternative markets. Tariff uncertainty creates secondary market opportunities in private equity. President Trump's tariff policies are creating significant uncertainty in the private equity (PE) market, potentially leading to attractive opportunities in the secondary market for investment companies. While initially seen as a negotiating tactic, the ongoing trade disputes and threat of escalating tariffs are impacting PE exit strategies and creating a challenging environment for portfolio companies. PE firms, already facing extended holding periods for many investments, are now confronted with potential further delays in exiting portfolio companies, particularly those in sectors heavily affected by tariffs. For example, electronics, apparel, manufacturing, and agriculture. This exit backlog, combined with a decrease in distributions to limited partners, LPs, and reduced capital available for new allocations, is driving increased interest in the secondary market. The increased due diligence, more protective deal terms, and lower valuations could create pressure for sellers, in particular those seeking to return capital. This creates a potential opportunity for investment companies specializing in secondary market transactions. They could acquire pay fund stakes, LP interests, or even directly purchase portfolio companies, direct secondaries, from pay firms facing pressure to liquidate assets, likely at discounted valuations, as a result of the current market situation. The heightened risk and uncertainty, while problematic for some, can translate into higher potential returns for well-positioned secondary market buyers with the expertise to navigate the complexities of these investments.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.